Good morning, everyone. It's Ted Bauman here with your Bauman Daily Friday video. I'd like to start by just noticing what's going on in the environment today. I'm recording on Thursday. The Federal Reserve has essentially announced that it is prepared to allow inflation to gather steam and run, and that's considered to be a pretty significant statement on their part. I think it means that to the stock market anyway, that there's a sense that the Fed is likely to continue to be very accommodative in terms of the policies that have supported the market throughout the COVID-19 crisis. And that seems to be good for the market. The market likes the idea of the Fed continuing to pump money into financial markets, or at least to backstop them with promises, because I think it's clear now that a lot of what the Fed does is simply jawboning, as they call it. They talk about supporting or being prepared to support markets like corporate credit markets. So they don't really have to do anything themselves. Everybody else takes the cue. They step in, they do that for them. Today, though, I want to talk about something that is probably under the radar screens of a lot of people. And it's something that I've noticed a lot of misunderstanding about in the comments in my previous videos, and that is the real estate sector. Now, a lot of people, I think, instinctively think of real estate in terms of residential housing. They think, so it's understandable that they do that, because essentially that is where the term is most often used. That's the context within which you hear the term real estate. But real estate is simply ground. It is simply pieces of earth. Now, on top of those pieces of earth, people build things, and that adds value. And a lot of what I mean when I talk about real estate is actually simply the facilities that are created on pieces of earth around the country and around the world that serve particular purposes. So I want to clarify today, I want to talk about what I specifically mean when I say I'm bullish on real estate. Now, in the United States and in some other countries that have copied our laws, we have what are called real estate investment trusts. They are essentially a corporate form that was created by Congress a long time ago. Back in the early 1960s, one of the last things President Eisenhower did, in fact, was to sign a bill into law which authorized the creation of REITs. Now, REITs have some pretty amazing characteristics. First of all, they are exempt from taxation on their operations. In other words, they don't pay corporate income tax. Instead, the people who own the REITs, the unit holders, they're called, I'm going to call them shareholders because it's easier to understand. The shareholders of the REITs pay income tax on the income that they get from their shares in those REITs. In exchange for that benefit, which is a pretty big benefit if you think about it, REITs are required to pay out 90% of their potential taxable income as dividends. That means effectively that once a REIT has made all of its investment plans, once it's spent money on maintenance and all kinds of other things, it is then required to pay out 90% of what's left to shareholders. Now, recently, in the December 2017 tax bill, a decision was made that under most circumstances, those dividend payments are exempt from any taxation at all on 20% of the income. So in other words, if you get income as an investor in a REIT, you only pay tax on 80% of that income. The other 20% is tax-free. Now, there's a lot of, bureaucracy and little tabs you got to fill in and all kinds of, complications around that. But fundamentally, that makes a REIT a very attractive form of income for investors. Now, the critical thing about REITs, though, is that they have a tendency to overreact to crises. And we saw this earlier in the decade. We saw it back in the 2008 financial crisis. But the critical thing is that they bounce back, and they bounce back quickly. So that provides two opportunities that I want to talk about today. But before I do, let's talk about the history. Now, here's a chart that shows what REITs did in the run-up to the 2008-9 financial crisis and what happened afterwards. As you can see on the left-hand side of the chart, there is a big drop here. Basically, that was the collapse, right? I mean, that was the big dive in the market at the end of 2008. Now, they bottomed out in early 2009, more or less second quarter. And look what happened afterwards. A consistent rise up, a couple of jags downward, really associated with other factors going on in the market, questions about things like whether the Fed was going to continue with quantitative easing, brinkmanship around federal debt levels, and all that sort of thing. But the trend line is unmistakable. And as you can see, REITs are recovered very significantly. If you work out the actual percentage increases, if you had bought at the very, very bottom, you're looking at something like pretty close to 100% gain during that period. So the first thing to say about REITs is that, given this history, that they tend to fall far and fast, but then they rise very quickly. And that presents two opportunities. So here's those two opportunities. The first is you buy in at a very low point when the REITs are down. And remember, they're companies that own fixed assets, real estate that has buildings on top of them. And I'll get to what kind of buildings in a moment. But fundamentally, what you're buying is a fixed asset that has intrinsic value that, in a sense, is able to backstop anything that the company does. Even if the company fails as an ongoing operation, there's still value in its assets. So that tends to help them out. But people tend to focus on the aspect of what the real estate investment trust does in a crisis, and they tend to dump them. So, for example, we're seeing right now mall REITs are taking a huge beating. Mortgage REITs, those that hold mortgages as securitized debt instruments, they're also taking a beating. All understandable because people are concerned about what's going to happen in the short term. But the critical thing about REITs is that the world goes on, and eventually people recover, people get back to business, stores reopen, new stores open, new uses are found from malls and other other institutions that REITs provide space to. And of course, people start buying houses again, they start taking mortgages again. There are all kinds of things that go on. So the critical thing is that when REITs fall as far and fast as they did, for example, in 2008, and as you saw from that chart, how quickly they fell earlier this year, it's a pretty good bet that buying into them at that price is going to set you up for significant gains in share prices going forward. Now, that's the first aspect of the opportunity. The second one, of course, goes back to the question of the fact that they need to pay out their income as dividends. REITs are required by law to pay out 90% of their income as dividends. Now, in a crisis, they may suspend those dividends to conserve cash, which is a sensible move. But eventually, if they're going to continue operating as a business, they have to resume those dividends. Now, the whole point of dividends is to try to buy them as cheaply as possible. So if you buy a company, let's say a company has been paying out a dividend of 5%, right? Now, if that company loses half of its value, its share price value, but that dividend payment remains the same, essentially that dividend payout, that yield increases to 10%, right? Because you're getting the same dividend for half the share value. So the whole point of grabbing REITs at the bottom is, number one, to set yourself up for share price gains, but number two, to lock in much higher yield on cost. Remember, your yield on cost is the yield that you get based on what you paid for the company, not its current share price. So you may see, for example, companies quoted right now with yields under 5%, but somebody like me or another investor in REITs might be getting a yield of over 5%, maybe even very much higher than that, because we bought them when they were at a discount during a crisis. So when I talk about real estate, folks, I'm not talking about suburban housing, although that's a separate issue, residential construction. I'm also very bullish on that. I'm talking about the kinds of real estate investment companies that control necessary assets in the economy. Now, let's talk about what those assets are. Fundamentally, real estate investment trusts they tend to buy critical infrastructure for the economy. So I've mentioned malls, that's retail. You get shopping centers that house things like grocery stores and so on, also necessary. But REITs are also big in things that a lot of people don't think about when they think about real estate. For example, last mile warehousing REITs that control warehouses that are built close to urban centers, which allows companies like Amazon, for example, or Target or Walmart or UPS or even the post office to be able to get the deliveries that they are going to be making into urban areas, into the city streets around us at the last mile. In other words, they load up their trucks at these kinds of things. Now, this is an important part of the e-commerce infrastructure, of the ecosystem of e-commerce. But a lot of people don't think about it. They think, Amazon has warehouses. That's great. Amazon does that. The thing is that between the Amazon warehouse and your house, there's often a secondary stage. And that is where a big truck full of Amazon goods with a big Prime sign on the side drives down to a local last mile warehouse, unloads its stuff, and then the smaller trucks pick it up from there. For example, here in Atlanta, if you ever drive on the highway from here to Chattanooga, you always see big convoys of Amazon trucks going back and forth. What they're doing fundamentally is taking stuff from a big regional warehouse in Chattanooga, delivering it to Atlanta, where it is then redistributed with smaller trucks that can fit into smaller neighborhoods. That aspect of the REIT universe is extremely profitable. It is one that has generated enormous returns and is poised to do even better thanks to the increase in e-commerce. So you can buy Amazon, sure, but here's another opportunity. The thing is that these REITs are getting beaten down along with all other REITs because people tend to lump them into one particular, the attitude is like, the REIT sector is bad. The mall down the street's got lots of shuttered storefronts, so I'm not going to touch REITs. And so they ignore these opportunities. And so that's one of the things here at the Bauman letter that we have done. We've actually targeted REITs that have this potential, really to piggyback, if you like, on e-commerce. Now, remember, this is not just an option for e-commerce companies like Amazon. They have to have these facilities. So these REITs, their demand for their warehouse space and eventually their real estate is inexhaustible. Nobody is going to stop using their services. So when their prices go down in a crisis, it's completely artificial. It's driven a lot of times simply by people selling exchange-traded funds that hold these kind of real estate investment trusts. And so it beats down their price unfairly. So first lesson that I'm trying to get across is that when I talk about real estate, I'm talking about this commercial real estate. I'm not talking about offices necessarily or malls. I'm talking about the stuff that you don't see. Another example of that is cell towers. Cell towers and data centers. Data centers is another one. Cell towers and data centers have been the best performing REIT sectors over the last 5 years at least. The Bauman letter holds one that is up by over 75% since we bought it a year ago. It generates a decent return. It's a company that operates data centers all over the world. We also hold one in the cell tower sector that focuses on the small cells that are necessary to deliver 5G. So fundamentally, if you do your homework, if you look at the value chain behind any given technological industry, somewhere along the line, there's going to be a need for real estate. And that is where you look for real estate investment trusts. And remember, in a crisis, everybody gets beaten down because people lump REITs together. Now, the smart investors know that that's not going to happen to the technological REITs like the data centers and so on, and to logistics REITs. But it also doesn't happen to things like senior living REITs or high-end apartment REITs, REITs that have basically income streams that are not going to suffer under pandemic conditions. I mean, a lot of people who live in expensive condominiums in major cities around the country, those condominiums are owned by real estate investment trusts, and the people in them can afford to make their rent payments or their mortgage payments or whatever it is, their condominium fees. And so these institutions tend to, these REITs tend to do well. Again, everybody thinks they're not going to do well, and that's why there's such an opportunity. Now, the REIT sector, whether you look at it from the perspective of just investing dividends or taking dividends or reinvesting dividends, has significantly beaten the market as a whole in the form of S&P 500 over the last 10 years. It's outperformed it. And the reason for that is simply because, as I said, it often starts from a much lower starting point. REITs tend to fall further and faster than the market in a crisis, and as a result, you end up being able to pick up bargains. The critical thing is to recognize that they are bargains, and that's what I'm trying to explain today, that I see REITs as bargains, and that is why I have stressed in the past that I'm keen on this. Now, I want to show another chart that shows recent developments in the REIT sector. This is a chart that shows an ETF that holds REITs. Its ticker is FRI, First Trust S&P REIT Index Fund. Now, as you can see, there was a more or less stable price point going right into the beginning of the crisis, peaked towards the end of February like everyone else. A big drop, huge drop in March, an initial recovery, another jag down, some sideways trading, and then a big move upwards in June. What we're now in with this particular REIT is what we call a symmetrical triangle, and that means that the share price is gradually converging on a band that is narrower and narrower. And in that kind of an environment, what we're looking for is a breakout in either direction. Now, obviously, my prediction is that this particular REIT, FRI, is going to break out upwards because that is the pattern. That's what happened in the chart I showed you earlier in the aftermath of the 2008-2009 crisis. Now, in that sort of an environment, now's a good time to buy this. Also, you could look at FRI, look at its top holdings. I guarantee you're going to see logistics REITs, you're going to see data center REITs, you're going to see cell tower REITs, you're going to see high-end apartment REITs. You're going to see REITs that are not obvious to a lot of people, and that is why this is such an opportunity. So that's really my message for this week. As I said, I noticed a couple people, someone asked, show me where real estate prices have gone up. Remember, it's not the price of the underlying land we're playing here. I think that's an important point. What we're playing is the profitability of the operations in the structures that are built on that land, whether it's a cell tower or a data center holding all the servers that run Amazon and Google and Facebook and Twitter and all those other operations, digital operations, or whether you're looking at something as simple as a shopping center that is providing grocery store space that is needed regardless of whether there's a virus or not. All of those potential real estate plays are based on the income streams they get because they provide essential services to the economy. It's not just about the value of the land. So that's my message for today. If you want to make money out of this, as we are doing in the Bauman letter, we have very, very good returns. Our yield on cost, our average yield on costs across our current REIT holdings is around 8.5%. So that's a very good return if you're a dividend investor. Things are going well in that sector for us. They could go that way for you too, whether you choose to invest individually in REITs or with the Bauman letter, as I would hope you might consider. Anyway, that's enough for me this week. I'll be back next week. Have a good one.